You lock in a low rate. You refinance to save money. You consolidate debt at 6% instead of 14%. This all sounds like winning, but sometimes the trap isn't the high rate you avoided. It's the low rate you celebrated. My name is Dave, and I spend way too much time thinking about how better terms can quietly make things worse. This one's for anyone who's ever felt smart about getting a lower interest rate, then looked up 3 years later and wondered why the balance barely moved. If this lands for you, you'll probably want to stick around. Here's what people believe. Lower interest rate equals less money wasted. And mathematically, on paper, per dollar borrowed, that's true. A 4% mortgage costs less per year than a 7% mortgage on the same amount. Nobody's arguing with that. The formula is clean. The logic is airtight. If you showed this to a mathematician, they'd nod and move on. The reason it feels so true goes deeper than math, though. We treat interest rates like scorecards. We compare our mortgage rate to our neighbors. We brag about refinancing from 5.5% to 3.8%. We screenshot the approval email and feel genuinely accomplished. It feels like proof we made a smart move, and in isolation we did. But isolation is the problem, because the interest rate is only one variable in an equation that includes time, behavior, and what you do with the difference. Let me show you what I mean with actual dollars, because this is where it gets uncomfortable. Let's say you have $25,000 in credit card debt at 18% APR. You're paying $650 a month, and most of it is going straight to interest. It's brutal. You're barely making progress. Then you see an offer in your email. Consolidate it all into a personal loan at 9% over 7 years. Your new payment drops to $400. You just saved $250 a month, right? On month one, yes. You absolutely did. But here's the math nobody highlights in the marketing material. At $650 a month on that credit card, assuming you stop adding to it, you'd have been debt-free in about 58 months if you kept at it. That's under 5 years. With a new loan at $400 a month, you're making payments for 84 months. You stretched it by over 2 years. And because the loan amount essentially resets the clock, you end up paying around $8,400 in total interest instead of the $12,000 you would have paid on the card. That part is better. I'm not pretending it isn't. But the behavior part, the part where the lower payment felt like breathing room and you stopped treating it like an emergency, that's where people get stuck. Because $400 doesn't hurt the same way $650 does. And when something stops hurting, we stop prioritizing it. We tell ourselves we'll pay extra when we can. We almost never do. Here's a second shape this takes, and this one hits homeowners. Mortgage refinancing. You bought a house in 2018 with a 30-year mortgage at 4.5%. By 2021, rates dropped to 2.9%, so you refinance. You save $180 a month. Feels great. Lower payment, same house, no-brainer. But if you restart the 30-year clock instead of keeping your original payoff date, you just added years back onto the loan. Even at the lower rate, you're paying interest on that house for longer than you originally agreed to. It's like finishing mile 8 of a 10-mile run. Then someone offers you a more comfortable pace if you start over at mile 1. Sure, the new pace is easier, but you're running 10 miles again. You're almost done. And here's what makes it worse. When you refinance, you also reset the amortization schedule. That means in the early years of the new loan, you're back to paying mostly interest again, just like you were in year 1 of the original mortgage. You escaped that phase once. Now you're back in it. The lower rate softens the blow, but the structure is the same. You're renting your own house from the bank all over again. Let me tell you about someone I know. We'll call her Jenna. She had a car loan at 7%, about $18,000 left with 2 years to go. Payments were around $700 a month. Tight but manageable. She was handling it. Then her bank sent her a letter. Refinance at 4.9% and drop your payment to $420 a month. She did it. Made total sense. Who wouldn't take that deal? Except the new loan was for 5 years. She turned 24 months of pain into 60 months of easier. And when the car hit 140,000 miles and started needing repairs, new brakes, transmission service, the usual stuff that happens when cars get old, she still owed $8,000 on it. So now she's paying a car payment and repair bills on a vehicle that's worth maybe $6,000. She's underwater on a depreciating asset that she can't afford to replace because she's still paying for it. That's the thing nobody mentions when they sell you the lower rate. Lower rates often come with longer timelines, and longer timelines mean you're married to the debt while life keeps happening. Cars break, roofs leak, jobs change, kids need braces. The longer you're in debt, the more chances life has to make that debt harder to manage. Now, I know the obvious counterargument here, and it's a good one, but Dave, what if I take the lower payment and put the savings toward the principal? And yeah, if you actually do that, you win twice. You get the lower rate and you shorten the timeline. You're paying less interest per dollar and fewer total months. That's the ideal move. But I've seen the data on this from the Federal Reserve's consumer finance surveys, and the reality is most people don't. The $250 you save gets absorbed into lifestyle, groceries, another subscription, the occasional dinner out. It disappears. Not because people are careless or irresponsible. It's because money is fungible and lower payments feel like relief, not opportunity. Relief makes you exhale. Opportunity requires you to stay tense and intentional. Most of us choose the exhale. There's also a psychological piece here that doesn't show up in spreadsheets. When you lower your payment, you lower the urgency. A $650 payment feels like a problem you need to solve. A $400 payment feels manageable. And manageable is where debt becomes furniture. It's just part of the room. You stop thinking about eliminating it and start thinking about maintaining it. You shift from, I need to get out of this, to I can live with this. And companies know this. They absolutely know this. That's why every refinance offer, every consolidation pitch, every lower your monthly payment ad leads with the monthly number, not the total cost. They're not lying to you. The math is real, but they're betting on your behavior, not your intentions. Here's the pattern you need to recognize, and this applies to almost every kind of debt. Anytime someone offers you a lower rate and a longer timeline, they're not just reducing your cost, they're extending your exposure. An extended exposure means more months where life can interrupt, more chances to miss a payment, more time before you own the thing outright, and more total interest even if the rate is lower per year. The trap isn't the percentage, it's the calendar. Think of it like this. If you're trying to lose weight, would you rather do something intense for 6 months or something moderate for 2 years? The intense version is harder in a moment, but you're done faster and you spend less total time in the struggle. The moderate version feels easier day to day, but you are on a diet for 2 years. That's a long time to maintain discipline. A long time for something to go wrong. A long time to get tired and quit. Debt works the same way. The shorter the timeline, the less room for life to derail you. But let me give you one more example, because I want to make sure this pattern is crystal clear. Let's say you have a student loan. You graduated with $40,000 in federal loans at 5.5% on a standard 10-year repayment plan. Your monthly payment is about $435. It's tight, but you're managing. Then you see an option to refinance with a private lender at 3.8% over 15 years. Your new payment drops to $290. You just freed up $145 a month. That's real money. That's groceries. That's gas. That's breathing room. But here's what just happened. On the original plan, you'd pay about $12,200 in interest over 10 years. On the new plan, even at the lower rate, you'll pay about $12,200 in interest over 15 years. You didn't save money. You spread the same pain over more time. And you gave up 5 extra years of your financial life to a loan payment. 5 years where you could have been saving for a house. 5 years where you could have been investing. 5 years where that $290 could have been growing instead of disappearing. You traded future freedom for present comfort, and the math made it look smart. I remember seeing data from the Consumer Financial Protection Bureau showing that the average borrower who refinances into a longer term ends up paying more total interest, even at a lower rate, because they rarely make extra payments and often extend the loan multiple times. It becomes a cycle. Every few years, when things feel tight, they refinance again, restart the clock again, and stay in debt longer. It's like a treadmill that keeps resetting your distance back to zero every time you get tired. So here's some questions to ask yourself before you celebrate a better rate. Am I actually paying less total, or am I just paying less per month? How much time am I adding to this debt, and what will my life look like during those extra years? If I take the lower payment, will I honestly redirect the difference, or will it just evaporate? What am I giving up by staying in debt longer? Flexibility, mobility, peace of mind? Am I solving the problem, or am I just making the problem more comfortable? What could I do with my money in year 11 if I didn't have this payment anymore? Here's the reframe. A lower interest rate is a tool, not a solution. The solution is getting out. If the better rate helps you get out faster, it's useful. If it just makes staying in debt more comfortable, you're renting relief. And relief is expensive when you pay for it in years. The short version, low rates seduce you into long timelines. Long timelines give debt more chances to win. The best rate is the one attached to the shortest payoff you can handle, not the smallest payment you can tolerate. You didn't get tricked. The offers are real, the math checks out, and nobody lied to you. You just optimized for comfort when you needed to optimize for speed. That's fine. Now you know, and knowing means you can make a different call next time. If this didn't help you, but you know someone grinding through a refi or consolidation decision, send it to them. It might save them a few years they didn't know they were trading away. And if you're wondering whether buying a house right now is even worth it when prices feel this unhinged, yeah, that's its own mess. What actually happens when people stretch to afford a home because they think they have to? That's a whole different shape of trap. This is what I'll be talking about in my next video. You can't miss it.